Inflation, the phantom menace of the economy, has been unrelenting, particularly in the realm of housing and rent prices. In fact, these two areas alone account for a staggering 42% of core inflation, or CPI. Over the past 2 years, rents have spiraled upwards with no sign of a downward turn. Even more startling, average US home prices defied expectations in 2023, refusing to drop. In some instances, they even climbed by 3%. Since 2019, US house prices have seen an astonishing surge of 30 to 40%. The Federal Reserve, the nation's central banking system, stands at the eye of this financial storm. Their strategy? Raising interest rates. The chairman of the Federal Reserve intends to cool down the labor market, a euphemism for increasing unemployment. The rationale behind this strategy is to deflate inflation. But does it work? Furthermore, is it equitable? Consider the everyday individuals who form the backbone of our society, the middle class, the working class, and even the upper middle class. These are the people who potentially lose their jobs and are forced to dip into their savings. Small business owners, the lifeblood of our economy, struggle, and some even face closure. In this scenario, who emerges victorious? The answer is clear: the large corporations and the big banks. When interest rates were low, it was a time of prosperity for all. Individuals could secure loans at low interest rates to purchase cars, houses, and more. Corporations too obtained substantial loans and turned a profit through investment and property resale. But when interest rates rise, the tables turn. Individuals lose money while corporations profit by investing in government bonds, which can yield a safe return of 5% when interest rates are high. These corporations also resort to layoffs and hiring freezes, saving money for further investments. While their stocks soar, they dismiss employees to maximize profits. Giants of the industry like Meta, Google, Microsoft, and Amazon have all laid off thousands of employees, yet their stocks stand at all-time highs. Is this equitable? We find ourselves amidst an era of economic unpredictability, pushing us towards profound introspection on the need for regulatory measures. One might question the indispensable role of policies in managing layoffs and averting potential job crises. It's crucial to analyze the trade-offs, benefits, and potential drawbacks of such policies in these uncertain times. Moreover, there breathes an argument suggesting that the government, as a hot seat, needs to devise all-encompassing strategies to combat the persistent and relentless beast of inflation. Role of the government in this battle is unprecedented, impacting every nook and cranny of our economy. The potential solutions to this economic conundrum could span from untangling the complex knots in the supply chain to enforcing temporary price controls. These measures could be a salve to the ongoing inflationary pressures. This discourse should not be a fleeting thought or a passing discussion, but rather a constant dialogue that welcomes and encourages diversified viewpoints. We must remember that this isn't just about the present economic conditions, but also about the future of our economy. We need to consider how these decisions can impact the giants of the industry, such as Meta, Google, Microsoft, and Amazon. Their logos flashing on your screen are not only symbols of their corporate identity, but also a representation of their significant influence in our lives and the economy. Your perspective on this issue is invaluable. Engage in this discussion by sharing your thoughts on this pressing issue. Every voice, every thought, and every idea has the potential to shape the future of our economy.